But the next thing you know, financial news, media, and parents at your kids' sports games, and the guy in the White House are all talking about privates. And you find yourself filming a video for your clients and potential new clients about private parts. Whoa, hold on. I'm sorry. That's not right. I'm so sorry. I cannot blame you one bit if you were sitting there saying, why on earth is this financial planner talking about that? Look, I'm a financial planner, okay? I am not a video editor. I'm reaching that point in my own life where I'm having to ask my kids for help with the computer. Let me rewind this for a minute and I'll show you how we got here. Most of you know, my wife Nikki and I have 3 amazing kids. And as every parent knows, you cannot overstate the amount of joy and happiness that kids will bring into your life. But parenting also comes with a handful of challenges, some of which you even know about and have time to dread well in advance. But chances are some of you are nodding your heads right now, and you know where I might be going with this. Inevitably, as every curious child builds on their understanding of their world around them and of themselves, they're going to reach a stage where they begin to want to understand their own bodies. And this, my friend, can prove challenging to even the most stoic of parents. Yes, I'm talking about the dreaded discussion about private parts. You're faced with this challenging moment where you have to reflect on your own understanding of things, and you need to simplify what is necessarily a complex subject in a way that not only helps to teach them about themselves, but also helps them understand why we use the word private. It's this awkward dance between helping them understand that there is nothing inherently bad about this, but there is also not something that we talk about with other people. And then there are these good things about it, and then there's bad things, and then there's bad things and good things. And the next thing you know, your palms are sweating, and your heart is racing, and you're questioning your entire life, and you're talking to a 4 or 5-year-old, and you get the picture. Ultimately, you do the best you can, and chances are you did a pretty good job, and your kids are thankful for it. And then you hope to never have to do it again. But the next thing you know, financial news, media, and parents at your kids' sports games, and the guy in the White House are all talking about privates. And you find yourself filming a video for your clients and potential new clients about private parts in the investment markets. Look, the reality is right now, private investments or private equity, this is the talk of the town. And it is reaching the point that I cannot ignore it any longer. Much like when kids are asking difficult questions, you are asking difficult questions. And I want to take the time to explore these questions, give you a sense of understanding that you're probably not going to get from those that are promoting these ideas out there. There's too many vested interests especially in private equity, but there's a lot of really unknown history about why this became such a big part of the public zeitgeist. But there's also a lot of context that we need to add to the conversation in order to make this conversation one worth having, and in order for us to really fully understand why this is gaining such a swell of let's say, public interest. And of course, I will provide you with a little bit of insight as to sort of how I see the landscape developing and what I kind of think about it as we look forward into the road ahead that we have for ourselves. This is not something that's going to go away quietly. So with that being said, let's kind of dive into it. Hey everyone, I'm Casey Fulp, CFP. I'm the owner and principal of Carriage House Planning, and I want to welcome you to this, let's call it deep dive discussion into private investments, private equity. There's a lot of words that are going to be used. Some of them are interchangeable. Some of them actually aren't interchangeable, but it seems like that's kind of what's happening anyway. So I'm going to try to dive into this fairly complex, fairly, I I almost want to say Wild West. It's not really, but for the average investor, it's going to be a bit of a Wild West world of private investments. And this is something that it does warrant discussion. But I'm going to also try to help bring some light to an aspect of this that I really think needs to be highlighted. And that is the fact that private investments, public investments, whatever it might be. And again, I'm coming from the standpoint of a financial planner and investment manager who is basing investment decisions on long-term time horizons. In other words, good quality investing over the lifetime of my clients and the people who I serve. And with that insight, I'm not looking at trading. I'm not looking at how to make an immediate buck today without taking into consideration the various consequences or the inherent risks that are associated, the higher risks with making a quick buck. It's not to say there aren't quick bucks to be made out there. There certainly are. There always have been and there always will be. But the reality is that for what we're doing, we're making decisions that are meant to be longer term in our consideration of them. And that matters, and this is what I want to lead off with. That matters because when we talk about any type of investment, it is critical that we first step back and remember what an investment is. This is, we live in a very fast-paced world. We live in a fast-paced world that is not only accelerating in terms of the information sharing, this is something I've touched on time and time again, but it's also accelerating in the sense that the access to and the amount of things that seem to be gaining attention for opportunities to invest or make money or whatever it might be, they tend to be growing in a way that most people can't really wrap their minds around. Whether it be something like a Bitcoin or a cryptocurrency marketplace, whether it be something like the events-based betting odds, which are cash. I'm blanking on the name of it. Kalshi, I think, is the name of one of them, where it's basically a betting house for events. So what are the chances that this football player picks his nose this weekend or something like that? And then of course there's the sports betting, the sports gambling. That has become the data behind it not only terrifies me, but it blows my mind in terms of how much money is moving hands on a regular week-to-week basis simply around sports betting and sports gambling. Even though the numbers are staggering, it doesn't surprise me when you see that the main players that are, capturing let's say the talk around sports, whether it be the ESPNs or the, similar sports media outlets, those same characters that are kind of building the story arcs around professional sports are also very heavily invested in the gambling side. And it's kind of one of those, that's such a dangerous thing. But that is part of our world today. And that's not to say that it's new. There's always been a get-rich-quick scheme. It's the multi-level marketing of the 80s and 90s. It's maybe it's something like the timeshare world of that same era. There's all these get-rich-quick schemes that they come and go, but do they stick? No. Do a lot of people get burned? Yes, way more than the ones that succeed. But that's not investing, right? That's speculating. You're making a speculative guess. It's a gamble. Investing is actually recognizing the theoretical potential in something over a long period of time, and you're willing to invest in it, meaning you're willing to put a bit of a time premium. You're willing to pay a time premium. You're willing to give up your, let's say, either liquidity or assets or whatever, and you're willing to put them in the hands of someone else because you believe in what they're doing, and that thing, whatever it might be, is going to be, it's going to create a greater amount of abundance in the future, and it'll be worth more, right? That's not to say that speculating isn't also betting that things are going to be worth more. It's just the amount of time needed for it to happen is so much shorter. Therefore, the risks are much, much greater. Whereas if you're doing an investment over time, right, you allow the ebb and flow of a natural market to take place. And you have your clear definitions on when it's appropriate time to get out, get in, whatever it might be. If the entire thesis on which you invested in this thing changes, of course, yes, you want to make a decision to maybe step away from it. But in the even the most technical side of my investment discipline, which is what I typically am, I'm a very technical focused investor. We have the same rules, right? When X doesn't apply anymore, or Y characteristic is no longer valid, or if the price, is to violate a certain level, that is a clear indication that the thesis has broken down and it's time to exit that position, right? But ultimately, that's what investing is. And it's an important thing to remember when we're talking about investments, because as we dive into a little bit more around the private equity or private company stock, the real question becomes, what are we doing here? What are we actually trying to achieve? What is the goal of private equity or private investments? And once we start answering those questions, I think it's going to help come back to the initial question that I ask of what is investing? And maybe the conclusions that we draw might be a little bit more enlightening than they, otherwise seem right now. I think a good place to start, let's talk about the pros. Let's do a pro-con type of thing. But let's talk about the pros of private equity, private investments, private stock. And some of these aren't necessarily going to be pros about the private stock so much as a reflection on our current state of our markets. Now, what do I mean by that? There's no secret that, and look, I'm a financial historian at heart. I spend tons of time learning about, researching, reading financial history. I love it. I'm a geek about it. Okay, I don't expect you to be one, nor do I expect you to sit here and listen to my financial history lecture. But what I will do is I want to bring some attention to a number of changes that occurred post-1980. In 1980, even though it's not the exact date, becomes a bit of a line in the sand for us because we had some very radical changes occur in the 70s that led into the 80s that helped define the state of our present day, let's say, modern markets. Now, some of that is political, changes and regulatory changes that it came as a result of that. Some of that is more just a matter of the nature of our evolving marketplace. But, in the 80s, let's say, yes, somewhere between 80 and 82, we had the infamous event that led to what would be, Paul Volcker breaking the back of inflation. That's something I've talked about endlessly through videos because it's such an important milestone in market history. But also, leading up to that, how did we get to a point where inflation's back had to be broken or justifiably had to be broken? There's arguments to be had there. But what led us ultimately to that point was really, yes, Nixon taking us off of the gold standard officially. That's not to say he was the only one that did it. That had been in the works for some time. We can go back to the Bretton Woods Agreement. We can go back to, really, in truth, we can actually go all the way back to the New Deal, and we can go back to Wilsonian era politics that really paved the path to get us to where we were with Nixon taking us off the gold standard. Now, I'm not going to sit here and gold bug out on you, but I'm going to say that that was a key moment that led to the hyperinflation and eventually the stagflation of the 70s that then in turn caused the Federal Reserve to make of course, the terrible decisions through the 60s and 70s with Arthur Burns, but then Paul Volcker comes in and he has this milestone moment where he hikes interest rates, at least on the short end, on the Federal Reserve lending window for banks, takes it from about 11% to about 22% overnight. Okay, now in the moment, in the time, right, things were already pretty darn bad. So the net effect of that move, while it wasn't fun, right? Anybody who lived through it didn't enjoy it. Markets didn't celebrate by any stretch of the imagination, but because things had been so rocky for such a period of time leading up to that, there's sort of like this irony in he did something that would have been very challenging for a market to stomach if the market had been running hot for a while. But because it had been so beaten down, it just sort of was like, yeah, what's another punch, right? It's the boxer who's sitting there kind of rocking and takes another blow to the head and doesn't knock him out, right? But it's like, well, that would look like a huge hit, and it didn't even phase him. Well, he was already phased, right? But that pivotal moment created what would have become, or what did become, the bond bull market that lasted about 40 years. We went from 82 to, roughly speaking, 2022. Now, did the bond bull market die, or did it end? No, but we went from overnight lending window, the overnight Federal Reserve rate, the federal funds rate at 22 or so. And while it went up and down along the way, there was this slow, precipitous decline into 2008, where we went into zero. We went all the way down to the bottom. Now, it stayed at zero, so that kind of, let's say, helped supplement the bond bull market for that last 10 or 15 years. But it was this steady decline. Now, why does that matter? Okay, the peak point of why that matters is it was a paradigm shift in the way that we look at investing, broadly speaking. Because bonds created this safe haven that they hadn't really been before. That's part of financial history that gets lost on so many people. They think, well, if I'm in a balanced portfolio, I own 50% stocks and 50% bonds. Or maybe a balanced with growth, I own 60 or 65% stocks and 40 or 35% bonds. Yeah, for the past 40 years, that's been, for better or worse, a decent way of measuring kind of your overall market risk. But that's not, through our long market histories that we have, that's not always the case, nor is it usually the case. Bonds are not a safe haven the way that people think they are. They're a safe haven, though, when you have a very controlled market dynamic like the Federal Reserve lending to banks, or a central bank that then backstops the banks, which, sorry, I'm going to go on a little tangent here. It should be noted that the Federal Reserve is a banking cartel. That's what it was designed to do. That's who it was created by. The big banks created it to keep themselves protected, okay? That's just the facts, okay? But it did what it was supposed to do. But by creating that safety mechanism built into our fixed income market, it also changed how we can invest on the stock market, the equity markets. So we started to build this kind of culture of higher risk stock investing. Now, we can see that in markets, and we can see the elevated movement in equity valuations as we move through the 80s, 90s, 2000s. And of course, yes, we do have the 2008 event. We had a couple of crashes in the 90s. Of course, we had the 87 flash crash, right? That was the Black Monday event. It's not to say that it was just a straight uphill road, but broadly speaking, because the investment dynamic had shifted in such a way, it allowed people to take a greater amount of risk in equities, and not just people, right? Institutions, whatever else it might be, because they kind of had this safety piece of their puzzle that previously didn't give them that reliable amount of safety. Now, was everybody always sure that interest rates were going to keep going down? No. There's plenty of question about that. But in hindsight, we can reflect on what was going on at that time, and we can see that dynamic was very much at play. Okay, some of the other things that we saw change is we saw during the Clinton administration, and again, this is more regulatory, but this matters. There was this big attack on corporate compensation. Now, was it justified? Arguably, yes, it would be justified. And I say that because I don't agree with it, but I could say it could be justified. And the answer was, we're going to really go tax heavy if a company's going to pay their CEOs or their leaders, their directors, their executives, pay them significant compensation in terms of their salaries, right? We're going to really go hard on them. And the companies answered and they said, well, then how are we supposed to compensate these people that are taking these? I mean, they're leading our companies, and whether they deserve the compensation or not, I'm not here to make that case or have that argument. But the companies were saying, if we want to attract the best talent, we have to compensate them. So here's what we're going to do instead. We're going to compensate them with company stock. And most of the regulators said, yeah, great idea. That's a great, you should do that because now they have skin in the game. Okay, a lot of arguments that I could make about why that is not actually a good idea. I know it seems counterintuitive. I won't get into that right now because, again, I'm trying not to take you on a whole history lesson, but I need to build this case to help you understand why private equity, private stocks differ, but also why there's so much interest in them. Okay? Now, you get that change, regulatory change with the Clinton administration, and as you started to see these companies adopt this new brand of compensation, you started to see, well, our corporate leadership is going to be compensated in much more of our company stock. So the corporate leadership sits down together and they say, okay, what are we going to do this next fiscal quarter? What are we going to do this next year? What are we going to do? How are we going to, A, benefit our company? But that's not really our focus, right? Because now we can look back on our principles as we learned in our business school, and that is to maximize shareholder value, right? That's still to this day. And that's been kind of modified. There's this thing called stakeholder value. Throw that out the window because that's complete rubbish. It's absolutely made up nonsense. It's not to say there isn't merit to what they're trying to argue, but the reality is that's not the way that companies should be run, nor is it the way that companies are run. It's a bit of a kind of a what do they call those things? A amuse-bouche or something. It's like it's just a little taste of something that makes you feel good. But it's not the meal, right? That's not the reality of the situation. Shareholder value is what corporate executive and corporate leadership are looking to optimize. Now, all of a sudden, they've been doubly ramped up in terms of how to optimize. Because now, or rather that they want to optimize, they're not looking at the companies the way that a small business owner looks at a company who's like, look, this is my livelihood and maybe my kid's livelihood. I'm building this business and also my community's livelihood, right? I'm the hardware store owner, right, in the one traffic light town. Like, I'm the only one that has the screws and the nuts and plungers and the whatever that my town needs. I need to have a great business because my community needs me and I need them, et cetera, et cetera. All right, that has gone out the window. You're not making decisions to benefit your customers at your own expense, right? You're not doing those kinds of things like we once upon a time did as businesses. Now all of a sudden we're maximizing shareholder value, and it's not because that's what we're supposed to do because that's what we learned in business school, because they've been teaching that in business school for a long time. No, now we're doing it because our compensation is now directly tied to that in a much greater amount each and every year. Okay, so then all of a sudden you get the introduction of, or the mass adoption of what is called the stock buyback. Okay, now all of a sudden we're using corporate profits and we're buying back our stock to elevate shareholder value. That got intertwined with, or the two rivers collided, and I say the two rivers, the rate environment where we had these ultra high rates coming down. So if rates are coming down over time, bond prices are going up. It created a safety net, right? But also rates are coming down. And then we have this corporate compensation change in the 90s, and they came and they met together, and they really met at a head right after we got the great financial crisis, the GFC, the housing crisis. Use whatever word you want, the 2006, 7, and then eventually the fallout in 8. Now, what happens when those two rivers collide? What really is going on under the surface is now all of a sudden we've got rates at zero. So relatively speaking, you can borrow money for no cost. So now all of a sudden companies are doing leverage stock buybacks. So instead of using their own corporate profits, they're keeping their corporate profits and they're keeping them in the tank. Because in reality, even though the overnight lending window, the overnight rate is 0%, the longer out you go on the what we call the borrowing curve, right? The longer you're planning to borrow the money for, right? Or lend the money for, depending on which side of the equation you're on, the more you can charge. But if you can borrow it at zero, I can borrow money at zero for a short amount of time to do things. I'm not going to use my capital because I can go and lock my capital up for 5 years or 10 years, right? I can go buy 10-year bonds or 10-year treasury bills, right? I don't want to take too much risk. The government, right? Risk-free. So these companies are saying, we're not going to use our corporate profits to buy back our own stock. No. We're going to go borrow the money at zero or next to zero, and then we're going to buy back the stock, and that's going to push our stock price up, okay? And then we can issue a dividend with our profits, or we can do all these other fancy manipulations, but we're not changing anything about our business. Our business isn't doing anything better. In fact, in a lot of cases, we're cost cutting and we're doing things worse, as we've all experienced. Cough, cough, appliances, cough, cough, cars, cough, cough. I mean, it doesn't matter what you talk about. We all know that the products that we buy today are not the same quality that they once were. They just simply are not. And they're seemingly getting progressively worse as we have subscription-based everything, right? And some of these other creative whatevers. Now, some have made a very good argument that part of the reason behind all of this is we haven't had any mass beneficial innovation, true innovation. When I say innovation, I mean landmark innovation, right? The type of innovation that would go with the internal combustion engine, the type of innovation that would go with the silicon semiconductor, the microprocessor, right? Those were landmark innovations. We haven't really had any of those in our modern era. Yeah, electric cars, not an innovation, okay? Yeah, the internet. Not really an innovation in the sense of did it revolutionize things? Sure, absolutely. And maybe I can say the internet was an innovation. I mean, I'm not going to try and build a case either way. I kind of jumped to say that. I'll take it back, right? Maybe that is the great innovation. But once it was created, we haven't really done anything that is massively impactful to change the dynamic, okay? Companies aren't creating great new the iPhone, sure. Smartphone, sure. But let's be real. It just took something that we already had, which was a computer, right? And just put it in our pocket. Now, is that cool? Sure. Is it distracting? 100%. I can promise you that. Is it great for society? Yeah. Boy, it came with a lot of costs, okay? But as I build that bit of a historical case, and there's lots of other stuff that has happened over that same period of time, but I'm looking at that convergence of those two major shifts, those two big things, because where that ends up leading us, in addition to the stock buyback, there's one other key pivotal shift that we saw in our markets, broadly speaking. And I'm not going to say that I can prove it, but I am very suspicious of anybody who wants to make a case against this. And that is, if we look back in the 90s, right? Right when we were seeing that big shift in corporate compensation, we had a tremendous number of publicly listed companies to the tune of, I think it was like 8,000 or something like that. I'm gonna see if I can get some graphics and maybe put them up while I'm going through this. The number of publicly listed companies has just drastically declined since then, to the point where it's about half of what it used to be. In other words, the number of stocks out there, the number of publicly listed stocks, now this is just domestically, but we can look at major economies and major markets, right? We look at London, we look at Shanghai, we look at the other, the Hong Kong, what would be deemed other significant players that were well established already, the Nikkei, right, in Japan. We can see that the number of publicly listed stocks has gradually declined since the 90s, and has declined precipitously since, let's say, the early to mid 2000s. Now, some of that, yes, came as a result of companies going bankrupt through the great financial crisis. I won't deny that. But the other side of the equation is that along with those stock buybacks, the other thing that companies were doing was the big companies out there were going, look, it's really risky to do major R&D, right? You'll look at the cases of GE. You'll look at the cases of IBM. You'll look at the cases of some of the chemical companies, Dow Chemical and the likes, where, Ma Bell, right? These companies that they were the real innovators of the previous generation. Where they got their funding, maybe there's a little bit of suspicious nature of some of it may have been more government than not. But the reality is, though, is that they were looking to innovate. They had massive R&D budgets, and they were looking to come up with great new ideas, and they would give them money to just go do whatever. IBM, right? That was another case of a company that would just innovate, figure out something, like blue sky thinking. Okay, was dead, right? And in 2008 forward, with 0% rates, the new playbook that CEOs started to deliver on, and this actually started before 2008, but boy, if 2008 wasn't the gift that just kept on giving because of that zero rate marketplace, now all of a sudden big companies said, we're not going to innovate, we're going to acquire. We're going to absorb anyone who even thinks about being competition. And then if there's a good idea in there, we're just going to take that good idea. This is not a new thing. This has always happened. But the rate at which it started happening and continued happening from 2000, let's say 8 through to where we are today, was a ridiculous acceleration. That is a key piece to this as well, because now all of a sudden you don't have these little companies whose goal is to get so big that they can't bear their own weight. They're too powerful. They're moving too fast. Their innovation, they can't keep up. They need to be able to pay for it. What are we going to do? We need capital. We're going to go to the public markets. We're going to go list our company stock publicly. And then we're going to keep trudging forward, right? Well, in addition to that shift, we had so many new regulatory burdens come in. The government, we know, has just grown and grown and grown and grown. I just had a conversation yesterday with a friend who's not the free market, free enterprise believer that I am, which is fine. I love having conversations with people who differ in their opinions. They were like, what would we? He's more of the stance of, we need the government and the government's systems for our success. I think that they get in the way, okay? But we have seen this, and this is where he and I both agreed, is that the pace of growth in our government was ridiculous, to the point where so many of the regulations and so many of like the self-serving regulations, where it's like we're just regulating because we need to prove that we're doing something, doing something for the sake of doing it. It got to the point where a lot of small companies were like, I don't want to IPO, in other words, provide it or go to the public markets by way of an initial public offering, because there's so much regulatory scrutiny, it's just not worth it. Now think about that. You have all this potential capital out there, and you want to grow this business and become the next, Disney or the next DuPont or the next whatever it might be, and do it in a better way, and it's too costly for the regulatory burden. Okay, so you have that combined with the fact that these big behemoth companies out there that did have a ton of capital, but better yet, could go and borrow it for next to nothing, if not nothing. And they're going, we'd love to acquire you because frankly, you're a fly and you're annoying and we want you to go away because you may actually start to eat our food, and we don't like that. Better yet, you have some cool innovations. All right, we're gonna go ahead and take those. So we reached this point where we got into this, the M&A, the mergers and acquisitions world became the dominant world. And we saw that with everything from the Oculus Rift being acquired by Facebook, which then in turn turned their whole name to Meta because they were creating the Meta universe based on the Oculus Rift 3D virtual reality headset, right? That acquisition completely changed the entire paradigm of this massive company that we know today as Meta, once upon a time Facebook. You can see very similar things in the case of Disney, I just mentioned. The acquisition of the Marvel comic universe, but Marvel, completely shifted the entirety of the brand. And don't forget, the other big acquisition was Lucasfilm. And now Disney is Marvel Comics and Star Wars. That's the identity of Disney. And then some garbage, kids movies that aren't actually for kids because they've got such insane adult ideologies built into them. But now the company's trying to backpedal like crazy because they're like, whoop, we overplayed our hand on that one a little bit. But the point being is an acquisition completely changed the face of this massive media company. Okay? You can look at these cases over and over and over again where the acquisition was actually the play. That was the R&D. Okay? So I've gone 30 minutes on financial history to talk about private markets. Why does this matter for private markets? This matters for private markets because we have some of the narrowest public markets in our own recent, let's say, modern market history. Narrow, what does that mean? That means we don't have a whole lot of public stocks out there. So all of this public capital that wants to invest in public companies, it wants to go somewhere. And it doesn't have enough places to go. Now, we peaked in terms of our publicly listed companies in the late 90s. Now, was that a good thing? All right, that was the tech bubble. There were companies that were publicly listed that didn't even exist. They were just theoretical ideas that went public. That's a problem. That's not good, okay? But that being said, up to that point, we had a fraction of the capital that's currently existing in our public markets. Okay, and it's getting so concentrated because we don't have that many stocks to buy. We can evidence this with something like, for example, this graphic. Now I'll put it on screen, but you can see here the largest S&P 500 stocks of 2025 by market capitalization. Number 1, NVIDIA. It has 7.5% of the market capitalization. In other words, the size of the S&P 500 index, 7.5% of it is represented by one company. The S&P 500, the largest American companies, the 500 largest American companies, 7.5% of that 500 is one company. Behind that is Microsoft at 6.7%. Apple, 5.6%. Amazon, 4.3%. Alphabet, and that's combined Alphabet, that's both share classes, but you've got 4%, Meta 3.2%, Broadcom 2.4%, okay? Tesla 1.8%, Berkshire Hathaway 1.8%, okay, at least there's some diversification in Berkshire Hathaway, right? JP Morgan 1.4%, okay? Combined, collectively, they represent nearly 40% of the S&P 500. Okay, that's crazy. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 companies out of 500, okay, is 40% of the size of the S&P 500. Okay, that just goes to show how narrow. So you go and buy the S&P 500, you buy the SPY or VOO or any of those S&P 500 ETFs that exist out there. If they're cap weighted, you are buying 40% of your money is going into 10 stocks. Now, has it succeeded? Has it been a great investment? Has it outperformed virtually everything? Yeah, it has. I'm not going to deny that. But does that mean a good investment discipline? No, it's a terrible investment discipline. That's not to criticize. Look, make money. That's what I'm here for. I'm here for you. But when you step back from it and go, wow, I never really thought about that. But it's also a reflection of what the state of our markets now, right? There's so much capital in these companies. And that's, you and I are talking as though, we're the moms and pops of the world. Think about the big institutions. They're having a crisis of conscience because they're saying that they have good investment disciplines and then they're going and they're chasing these same companies and they're overweighted and they're overconcentrated. And if something were to pop, anything, that could be detrimental. It's so hazardous. All right. And then the next question becomes, how do these companies keep growing? We know we have a long, long history, right? We can go back to the shipping companies of long ago, and then the whaling companies. And we can see like there were these dominant players that were disproportionately huge compared to anyone else, right? The Dutch East Indies company, and I'm trying to think of some of the others that would have stuck out in people's memory. But the reality is Westinghouse, right? There's one until GE came along, and these companies were these behemoths, but rarely can they innovate at a pace that maintains their behemoth status. So then what happens if these companies start to fall off? Or what happens if the demand is just not there to supplement the price, right? The price to earnings ratio is just out of whack, or whatever else it might be. Who's to say, bear with me here as I try to get this thing to there we go. Who's to say that these things are impervious? They're not. Now, does that mean that the government steps in to protect them if they start to get sluggish? I'm not going to discount it because of how dangerous it is. But that steps into what we're talking about today, which is why on earth are we getting the guy in the White House talking about issuing orders so that private equity can now be a part of 401ks? By and large, most 401k investors are incredibly passive. Either it's a lack of competence or comfort in making elective decisions in their 401ks. That's where most Americans invest because that's their chance at actually having a sustainable retirement of any kind, right? We don't have the defined benefit plans of yesterday. The pension plans is the way that we would talk about them, but we call those defined benefit plans. We have defined contribution plans. That's your 401ks, 403bs, 403as. 457 plans, you name it, right? Where they have a section in the IRC, the Internal Revenue Code, that allows for tax deferral in most cases, or tax-free if it's in a Roth 401k or something to that effect. But you get tax benefits for putting money into it, so you get a little bit of a perk today. But the idea is you're putting money away for tomorrow. So much of that money gets defaulted into default investments. And more often than not, for most plans, the default investment's going to be something like an S&P 500 index fund or a blended fund where it's your target date retirement fund based on your age, which if your age is anything more than, let's say, 5 or 10 years from retirement, most of it's getting into an S&P 500 fund. Maybe a Dow, a Dow Jones, but not likely. Maybe some broader blended or equally weighted, but not likely. More often than not, it's an S&P 500 index fund. Okay, so we've got all that capital for the average American sitting in what I just showed you a minute ago. So then you say, well, what about all the other investments? There's plenty in every plan. There has to be in order to meet their fiduciary obligation based on the ERISA laws, which are the laws governing management of those plans. However, most investors don't go in and actually occupy those investments because they're scared or because they don't have a good plan advisor who's actually helping them make educated decisions on their money, or they don't have a financial planner or a financial advisor who's helping them look at the options available in their plan and make those decisions for them. That's something we take very seriously. We work with a third-party platform that actually allows us to help manage our clients' 401ks because of that trepidatious nature around them, or they're just too busy doing their job and living their life and working with their family or being with their family and whatever it might be, and they're like, that's what I pay you for, just do it. Wonderful, right? At least we're putting eyes on it and we're doing what we're supposed to do. But most people are not doing that. So then the question becomes, well, what good would it do if he allowed private equity into 401ks? It would do a world of good for a certain number of people. And that's a bit of a misleading statement, and I do that on purpose. A world of good for the people who are managing their investments, right? Oh, look, this whole new suite of investments. And that's where I'm going to really break down the pros of this, the pro-con. But yeah, oh, wow, I manage my 401k and I'm in there regularly and I make adjustments and I, analyze markets and whatever else it might be. And now all of a sudden I have this entire new opportunity set of companies that I can't access otherwise, or I could access, but I don't have the capital to get in because there's capital requirements, or I don't want to use my money that's in my taxable brokerage account. I want to use my IRA money because there's liquidity issues with these funds. That's a big one. I'll come back to that in a minute. But those people, yeah, okay, they might stand to benefit, might. Because they're saying to themselves, well, daggone it, the funds that I have to invest in my 401k here, most of them are S&P or S&P adjacent funds. And I don't want to put 40% of my money in 10 stocks. I want to diversify, or I want, right? So, okay, that's maybe a pro. Maybe that's one of the pros. The reality of the pro behind private markets, if I'm going to make a case for them, is the private markets allow investors an opportunity to broaden their investment horizons across more companies, more industries, more sectors, right? You think about I'm going to make up numbers because I don't really have anything good, but you look at I'm trying to think of an industry that's pretty thin. Maybe railroads. Okay. And I'm making these up. I actually don't know. I don't think Brightline is publicly traded. I think it's still a private company, but I'll use Brightline Railway because as a growing up in Florida, and now we're no longer in Florida permanently, my family, but I still keep very close tabs on my home state. In Florida, they have this private rail that's built between Miami and Jackson. Well, eventually I think it'll be Jacksonville, but Miami, Orlando, Fort Lauderdale, and then they're going to try and tie into Tampa and all that. And it's a commuter rail. It's a high-speed rail. You got that. But then if you want to go invest in railway, right, you get your Norfolk Southerns and your Union Pacific or whatever else it might be out there. But there's not a ton of players. And if you're looking at those companies, and let's say you're a fundamental investor and you're like, well, I don't like the balance sheet, or I don't like, the price to earnings ratio on this, or I don't like the contracts that they're signing, whatever you might be analyzing. I want to invest in rail because I believe in rail, or my thesis is that rail's good or whatever. But there's only 4 or 5 different players. What am I supposed to do here? Well, now all of a sudden with private markets, you have theoretical access to those smaller companies if they're interested in getting private equity or private market money. So that's, again, I'm building a case pro private markets. The inherent kernel of importance here is that we have very narrow public markets right now. We need broader markets. But until we can rehab the cultural issue around public markets, and that rehab process will be making the regulatory burdens far less for a company to go public, meaning those companies shouldn't have to go through the incredible expense of all of the, and it's not to say airing out their laundry, but the market will air out dirty laundry. It always finds a way. Just look at all the politicians' dirty laundry that gets aired out. Look at people will air out dirty laundry. A free market will air out dirty laundry. You don't need a regulator to do it for you. Okay? But regulators make a lot of money on being the ones to air out the dirty laundry on the average investor's behalf. And I'm sorry for being a little sarcastic, but the regulatory hurdles are insane. And then they sit there and bemoan that we don't have companies going public. Yeah, because you're making it impossible for them to do it. Okay, stop with that. Secondly, though, we have killed off the entrepreneurial mindset. The idea of a young, presumably, person who has a great idea and wants to truly grind their nose against the grindstone year after year and get to that point where they are ready to break out, and instead of selling and just cashing in, they're going, I don't care about the money, I care about the vision of what I'm doing, and I'm going to make this the greatest company ever, right? It's the Henry Ford of yesterday. It's the Enzo Ferrari. Forgive me, I'm a bit of a car guy, so I tend to gravitate towards those names, but it's the Michael Dells, the Hewlett Packard, the IBMs, the Jeff Bezos, the ones who said, I'm going to do it, and I'm going to grind, and I'm going to do this the hard way. And then they reach that critical, that escape velocity, and they go, all right, it's time to bring in extra capital, and I'm going to go public. And then all of a sudden, others can join me in this great expedition towards changing the world for a better way or making the world a better place. Without that, we're not going to be getting these big public companies. Instead, we're going to be getting this harvesting slop that we're getting now, where it's I'm going to build something up just to give my good idea, and I'm just going to cash out, and then I'll take my money and I'll go do some other thing. Not saying we need more martyrs, but in a way, for every one Jeff Bezos, right, there's 100 failures, but you need those odds. And right now we don't have those odds. We don't have that number of people out there looking to do it, right? So without that, where do investors go as we look at the potential continued consolidation, the everything corp problem? There's plenty of movies, whether it be Idiocracy or Wall-E or I think RoboCop, trying to think through, these dystopian futures where this amalgamation of all of our industries get wrapped up under one conglomerate. And we're all basically slaves to this massive corporate entity that's also the government and everything else. If we're going to continue on the track we're on, that's where we're headed. So private equity, private companies that don't want to go public but still need that capital, okay, that's great. That's the pro side. Now let's flip over to the con side. Here's the problem. This is an industry that did offer tremendous opportunities for investors, and it's been around for quite a long time. In fact, there's a gentleman, David Swenson. He's the CIO, or was the CIO, I don't think he still is, CIO of Yale Endowment. He is kind of the name that will come to mind for anybody who knows the history of private equity or private investment. He's the one that he made the critical statement that everybody's ears just went, wait a minute, oh, I didn't think about that. Or it was an attention getting, and he wrote a book, and in the book he talked about the importance of private equity for outperforming returns over time in their investments. And Yale has historically very high success in the management of their portfolio. Now, with that, there was this glut of interest in funding private venture. But as that market started to mature, and it matured very quickly because it was a bit Wild Westy, and because it was a very high risk, so it took a certain, imagine, a very high risk endeavor is going to take a certain personality type to go and get invested in there. It's going to take that hard-nosed, willing to risk it all type of person. And if you get a whole bunch of them in the same room, if they're willing to risk it all, right, they're also willing to do really risky things, and they're willing to manipulate their own environments to their own benefit, not necessarily illegally, just in general. And that's really kind of what ended up happening. But they got to the point where they went, wait, hold on, we've got a new recipe. It's not we're investing in these companies and letting them do what they want to do. We're looking for distressed companies that need capital because otherwise they're going to fail, which is a lot of times what you're getting with private equity, right? They're not at the point where they're like, I just need capital to grow to that next stage. It's more like, I need capital because I can't sustain and I'm being managed very poorly. So I'm going to bring private equity in, and then they're going to bring in a management team, and they're going to help me manage this company, and more often than not, they're going to push me out the door. And that management team is now going to go through, and they're going to look at the company, and they're going to basically find any bit of value they possibly can. And if it means cutting the company down and chopping it up and selling off parts, they're going to do that. If it means cutting the workforce down and saying, the heck with the 300 people who've been working here since day one, you mean nothing to us, therefore you're out. But it doesn't matter what they do because they come in as profit makers. That's what they're there for. And that's what's happened for the past, let's say, 20 years in private equity or private. There's also been a lot of regulatory changes that have made it more interesting for more investors. So you got like what's called the carried interest loophole. And that's a very controversial subject. I'm not getting into it, but it has played a part of this. There's also some other regulatory things, but then we've also had the technology advances that have allowed for new platforms for think about the GoFundMes of the world, right? Where we're crowdsourcing money for, my look, I've got a new nose hair trimmer idea. I'm going to go on GoFundMe and get people to help me so I can make a prototype, or whatever, or a new movie or something. There's all kinds of ideas. But that premise kind of applied in the same way to the private equity markets, where these platforms kind of emerged, where it's like, angel investors or seed funding, what would be kind of early stage private equity, or late stage, funding. They could all kind of come together and take vested, proportional interests in different endeavors, so that company that they needed X amount of money, but this company said, I don't want to do it, and I also don't want to partner with anybody else. So that company's like, well, we can't get any money if you're not going to do it, but you don't want to go all in, but we need this amount, but you don't want to partner with any. Well, now it's like, they can all kind of partner but not even know it. There's some other things that have gone on, but I bring all that up because the real money was being made, but then it just became more of a, let's see how we can slice and dice these distressed companies and make our money. And I bring that up because I want to highlight the point about private equity. Private equity rarely, because of it being private equity and the way that they're going to package private equity for the retail investor, the U's and I's of the world, right? It's one thing if you're a private equity partner, think Shark Tank, right? If I want to put on a tinfoil hat for a minute, I would be like, the entire premise of bringing Shark Tank into the public zeitgeist was to prime them to get the average mom and pop ready for private equity to go mainstream, right? That's the tinfoil hat. There's this cabal of decision makers, and they said, wait, here's what we have to do. We have to prime the public's attention on this sexy idea, and then we're going to give them access to it so that we can cash out, right? Like I'm joking to some degree, but I mean, I'm looking at it going, that's completely plausible. Like that would have been a great idea if it were constructed that way, because that's what happened. People, they kind of have there's a sexiness, this desirability. Well, wait a minute. I want to take a position in this great new idea that you have, and then I'm going to profit from it because it's going to do great things. Okay? That's what private equity partners do. Now, if they're general partners or limited partners, however they're structuring the deal, right? We're going to get a portion of your revenue, right? We're going to get a portion of ownership and revenue. Or we're just going to take ownership. But then we're going to put our management team in. So now we're basically just like kind of co-opting your idea. When it comes to what the average retail, again, I use the word retail, but think of it as the Main Street investor, the U's and I's of the world, the not big institutions, the not big funds of private equity funds. This is the U's and me's of the world. The packaged product very rarely is going to be packaged in a way that you're going to participate in the actual growth of the company. Where your participation or your performance is going to come from, more often than not, is when those companies get sold for a profit. Okay? That is a key part, because the valuation of private equity investments is no man's land. Now, that's not to say there aren't rules and regulations around it. There are, kind of. But the reason it matters is because there is so much trickery that can be done in paper value on private equity deals that make it look like something that it's really not. There are loads and loads of stories of, let's say, let's call it, there's some real estate investment trusts that are structured that, through the ebb and flow of the real estate market, they would tout themselves as, look at how little volatility we have in the price of our fund, in the price of our real estate investment trust. And we're going to go back in history. They're touting that as, this is why you want to, invest in us. The S&P 500 has done this and this and this, and we've just, but you're going, but wait a minute, real estate has not gone, right? And think not in terms of the past 10 years, think way before that. But these real estate investment trusts, what's really happening though is, if you think about it, they don't actually realize a value on a piece of real estate until they actually sell it. So as long as they don't sell anything, their value stays stable. Now, do they have to mark to market? Well, it depends on what they own and how they own it and how it's structured and everything else. But that same nuance and that same what the hell's going on under the surface? That applies in the private equity space too. So you'll get what's called an NAV, right? NAV is a net asset value. That is something that we use when we talk about ETFs or exchange traded funds. That's something we talk about when it comes to mutual funds. It's something we talk about anytime we're packaging up a bunch of different things into one package, right? We have the net asset value. All right. Now with a ETF, for example, if I'm packaging up publicly traded stocks, maybe it's the S&P 500, whatever it might be, I have buyers and sellers every day trading shares of those stocks. I know what the market says the price is. Now, whether that's the right price or the wrong price, I will tell you it's the right price because that's what investors agreed upon. Otherwise, the transaction wouldn't have occurred. Okay, but they decide on a price. Okay, that price is constantly being calculated by our markets. And then we know what the net asset value of the S&P 500 ETF is, not only through the day, but we definitely know at the end of the day, after all those trades have settled out. Okay, so I know what my investment is worth. Now with private markets, a lot of times what they'll do is they're buying distressed debt. Or excuse me, not distressed debt, but they're buying a distressed company. But that company's private, so it doesn't have buyers and sellers constantly saying, this is what I think the stock's worth. This is what I think the stock's worth. No. It's private, right? So they get a valuation done, but that valuation's done quarterly. Last quarter, that company may have been valued at, whatever, based on what type of valuation they use. Maybe it's a price to book, or in other words, kind of valuing out the tangible assets of the company, or some other valuation metric done by even the most well-intentioned, compliant valuation. But the reason the private equity firm, the private equity partnership comes in and buys interest in this company or funds them, in other words, gives them, equity in exchange for shares, is they know that company is distressed. They know that something happened. Maybe the CEO, had a heart attack, right? And that's not public information because it's not a public company that requires public reporting. That's private information. And maybe they found that out, or the CFO of the company came and approached them and said, hey, we need capital. Something happened, blah, blah, blah. Well, they're still using a valuation on the previous quarter. Now, there's perhaps knowledge of why the company is distressed. But the private equity company is now looking at it going, okay, we've got an opportunity. But if you're invested in that, right, if you have your capital in that, you're not getting transparency because you're buying it at a premium. You're buying it at last quarter's valuation. And this private equity company actually knows this isn't actually, we're picking this company up for pennies. But then they immediately mark it up to whatever that book value was or that private valuation was. So you have a lot of, for lack of a better word, there's a lot of transparency issues in the valuation of private equity, private companies. And there's, I'm sorry, I don't have better language. This sounds silly, but it's accounting witchcraft. It's wizardry and witchcraft. It's waving magic wands over spreadsheets and making numbers appear out of thin air. That's really dangerous. Now, am I in turn somehow magically going to start, going to bat for more regulation and that kind of thing? No. That's not the answer. That is an inherent risk of something that potentially has a greater degree of reward. So, again, my principles and what I espouse to others, and I encourage them to recognize is the importance of a free market being allowed to go through price discovery. With private companies, of course, price discovery, it doesn't come so naturally because there's not a wealth of information that is displayed publicly, be it to shareholders, because there's usually not a lot of shareholders. But now all of a sudden, if we introduce this concept of private equity where we have a lot of shareholders, but they're all consolidated under the wrapper, right, or inside of the shell of this private equity fund, right, there's not a lot of dissemination that has to happen. So whereas a publicly traded company or, even GoFundMe, right, you can see how many people we don't have those same regulations. And then there's some other issues, and I was listening to an interview this past week that highlighted a rather standout case of a private equity company that they had basically a commission that was tied to basically the sale of an asset. So they got paid, right? The management team got paid when they bought a distressed asset. They bought a company that was in a tough space, rehabbed it, and then sold it into the market, or sold it to another company, or sold it to whoever, and made a profit. So they got their percentage on the profit. But somehow the shareholders of this, and this isn't even like this isn't an investable investment like you and I would think, where we're talking about like in a 401k. So this is a case where this was a limited partnership situation. Excuse my dog as she walks by, where the limited partners voted to allow the general partner, the controlling parties, to actually take their, let's say their commission on the net asset value of the underlying companies when they weren't even sold, right? So it's not realized. So that would be like saying, like, I'm going to go and list my house on the real estate market, and I'm going to go ahead and compensate my realtor based on the asking price, even though we haven't sold it yet. Then it's the equivalent. You can see where the issue is there. Well, what if the house doesn't get what you're asking? What if it gets a third of what you're asking? They still get compensated all the way through. So we're having issues like that are already starting to emerge, and we're going to see more and more of those kinds of stories emerge, because this is a bit Wild Westy. I mentioned that way early on in this conversation, where to some degree it's Wild West. Even though it's been around with a small number of players and a small number of very, and I don't say the word sophisticated to endow them with any kind of great, credence or I'm not showering them with praise. I mean that sophisticated in the sense of that at least they're very well familiarized with all of the theoretical and potential threats that exist in this world. But as soon as we, and this is almost I'm going to use a word that's going to sound good, but I don't mean it well. When we democratize, right, the private markets, and we do allow them to, let's say, enter into the 401k space, the issue is who floods to it. Now, again, let me reiterate, I'm a free marketist generally and across the board, like in the most broadest of senses. So do I think that they should be excluded from 401ks? No, I don't. I don't think they ever should have been, assuming there's a way that this can be packaged up in a way. But that's the problem, is this entity, this idea. We go back to the very beginning of our conversation, which is this idea about how do we define investing, right? By virtue, very few of these positions are going to allow you to partake in the growth of the company by way of revenue growth, by way of client growth, by way of impact on the world, the ways that you're going to participate if you're owning shares in another company, right? If you own, a company, and not only does their value grow because the market likes it more and they're willing to pay more for the stock, okay, because it's publicly traded, right? On the private, the only way you would participate in their growth is if you in fact get revenue percentage sharing on the revenue of the company. But if that's not an option, the only thing you are banking on to actually grow your value is you need to grow by selling the private companies that this particular investment buys. So they buy a company, they rehab it, or they gut it, or they whatever, they sell it, now the profits come in. Okay, now you have investment growth. But that's not investment growth, right? That's not you, because you don't even know what companies you're owning under the surface. So that's why I say it really shouldn't be packaged up in 401k, because the parameters of a 401k are so limited by virtue of how they structured that. So it's one of those, like, this is where the domino starts to fall. If you let this in, right, you would need to restructure it. Well, if you need to restructure it, you need to restructure 401ks in general. You need to take mutual funds out of them. You need to let it be individual stock selection. If you want it to be, tit for tat or comparable. That's not happening. So the idea that you get this is like, it's very Band-Aid, it smells of a Band-Aid. It's like, well, we have such narrow markets and we're really baking a cake that's got some poison inside of it, right? By having these over-concentrated, very narrow markets. So the way that we're going to diversify that, and forgive me here, but God forbid we actually diversify out of the United States, and that's why the Trump administration is pushing for this. This is a way to keep capital invested in American companies, okay? Because so few, respective to history, so few of our companies want to go public. This is the way they do it. Because the other way to diversify away from the risks of the S&P 500, which I showed earlier, and everything else, is you go and you move your capital into other countries' publicly traded stocks, right? You go and invest in the Nikkei. You go and invest in Brazil. You go and invest in, Europe or London or Hong Kong. It doesn't matter. But that is the antithesis of the at least portrayed, the professed objective of the Trump administration. So this is sort of like they're wanting to have their cake and eat it too. And again, the cake has some poison kind of built into it. So how about neither one? How about we kind of step away from this? So, that's really where you can kind of tell already. I'm pulling my notes back up here. But that's really where kind of the crux or the real issue comes in with all of this, is you have major valuation problems with these. Earlier, I think I was alluding to like the real estate investment trusts, just like there's no volatility. And I don't think I finished that thought, but effectively, like the theory, the story behind that's like when you don't actually sell the underlying investment, right? It doesn't get a valuation. So you're using made up numbers, right? Because when it comes to something that's private, something that doesn't have a ton of shares spread across a bunch of different owners that are then vying on an open marketplace back and forth saying, this is what I think it's worth. This is what I think it's worth, right? This is how much I'm willing to sell it for. That's how much I'm willing to buy it for. And they kind of do this game and then they finally meet right there. And it's like, okay, well, that's the price. That's where the buyer and the seller decided. Now, is that what the company's worth? No, that's not always the case. That's the beauty of our markets. That's the beauty of a market in general. It may be I have to sell it because I need the cash, right? There's liquidity. Now, I'm going to talk on that because that is something I mentioned earlier, and it's a critical piece to this entire puzzle. But if I need it, I'm willing to sell it for less than it might be worth. But because of that, now all of a sudden, other investors come in and say, no, but I think it's worth more than that, but I can buy it at and then you always find what the company is actually worth to the net ownership, right? The net buyers and sellers. Now, speaking of liquidity, that is another issue with this, is a lot of times with these private deals, these private equity markets, private stocks, you have liquidity constraints. What does that mean? That means you buy into it and you cannot get your money out of it when you want it. You get it out of it on either a schedule, or you get out of it when they have the capital available. You put in a request. And if 10 people request all at the same time, they only have to redeem what they are capable of redeeming, right? Or if it's on a schedule, then you can only get your money out once a quarter. Well, imagine how much happens in our fast-paced world. I mean, that's, again, we started off, like the speed of everything is different today. Liquidity is something that I harp on with all of our clients, because we are financial planning clients. We are planning around our financial lives. Okay, that's very different than being Warren Buffett with his Berkshire Hathaway or any of his investments post 1970, right? He had enough capital, enough assets built for himself. He could live his version of life, which, remember, is driving the Lincoln or the Ford and drinking the Diet Coke or the Coke, whatever. I can't remember what his I think it was Coke. That's the life. He's the billionaire, trillionaire next door. In terms of, billionaire, but that's his persona. That's his life. So he had enough capital. So now everything else that he does is, let's call it infinite timeline capital, right? I can invest in this. I don't need my money out in 1 year, 2 year, 3 year. I don't need my money out if something bad happens. I've got that covered. This is, I see potential. Eventually, I'm going to put my money in there, let it go, right? That's what traditionally in history we call sophisticated investors high net worth investors, they often have access to types of investments that have liquidity constraints because they can do it. This is not a rich versus poor. They don't let us into it because we don't have enough money, and that's the argument that you get on media and all this other baloney. No, that's protecting you from yourself. I'm not saying that it wouldn't be wonderful for you to be able to partake in the benefits of these investments. I love that aspect of it. But if you either don't know what you're getting into, or B, you've got liquidity problems, okay, you're going to kill yourself with this type of stuff because life happens. Now, that does make the pro argument for put it in the 401k, right? Because that idea is, all right, that's money for tomorrow. I've got time. However, that still doesn't resolve the issue of the liquidity underneath. Because what if, I don't know, something, terrible happens with U.S. Tensions with some other, superpower or whatever, and major war issues come up, and you're in a private equity fund that's primarily in like peace flags or something. I know that's a terrible analogy or example, but you get where I'm going. Like, you're in a private equity fund that targets companies that would be, sorely hurt by some type of geopolitical conflict or some type of, COVID something. I really don't know. I'm trying to come up with a good example off the top of my head. The point is, though, hey, I want to move out of that investment. No can do, bud. You're stuck. You're stuck until the redemption period. You're stuck until whatever. Okay, now all of a sudden you're saying, I want to make the right decision. Or if your financial advisor, your professional that you're working with is like, hey, you got to get out of this thing. And you're like, but I can't. I'm stuck. Right? We saw that with real estate investment trusts in 2008. People, give me my money. I see the real estate market's hemorrhaging, and it's like, we can't sell any of the assets that we own. So no, we're not giving you your money. Now, by the time they actually had capital available to pay people out, was like the worst possible time to get your money out, right? Because we know what happened with the real estate market since then, right? It's recovered and then gone to infinity and beyond. But like, that's the problem, is it creates major conflicts for investors. So liquidity, are there a lot of private companies that haven't already been milked? Yeah, they exist, but chances are a lot of the great benefits of private market investing, as of right now, until we start to see some real grit in our founders and in the startup companies and in the private companies. That's not to say the mom and pop companies don't have tons of grit. They do. But the companies that these private equity firms are investing in, they're the ones that, again, they're either distressed and they've been in trouble, or, they're small companies that they just can't get acquired, but they still got a decent idea, but they don't want to go public. They don't want to do it the hard road. So it's like a self-selecting thing. So, this is not a hill I'm going to die on, but it's certainly one that I will fight for. And that is to say, we live in a world where there's going to be more and more get-rich-quick schemes that pop up each and every day. And because we have the ability to spread the news about these types of things more readily, right? Social media platforms and everything else, people are going to start gravitating more and more to these types of things. But the complexity underlying these things and the issues that arise because of that complexity are not going to be understood. And that's not a new thing, right? There's nothing new under the sun as far as that's concerned. However, the desire for people to seek out that get-rich-quick scheme seems to be growing. I don't think that that's just anecdotal observation. I think that that's something that we're definitely witnessing. And because of that, there's I think a greater risk of more people getting hoodwinked. And again, I'll put the tinfoil hat on one last time as I kind of close this out, but there is a faction of folks who I think there's a lot of veracity in this argument, that part of the other driving force behind this put them in the 401ks thing is there are a lot of heavily invested private equity firms, funds, whatever it might be, who they stand to benefit greatly if there's a mass flood of interest into this space. So they'll ride that up, but they are also the ones that were ready to get out because they see that this is the end of an era as far as private equity goes. Now, I could easily see that if we see some more regulatory tapering that we might get with this administration, which is actually a positive thing, we may find ourselves with a landscape that is more opportunistic for companies to go traditional IPO direction. I don't think we're ever going to get back to where we were once upon a time because there's so much that has changed in the types of share classes for offerings and the types of offerings and the way that the investment banking space is. Until these big banks get knocked down a notch or two, until the capital concentration in the highest of high net worth people and businesses, until we start to see that spread back out, which I'm not going to call for or wish for a catastrophic event, but oftentimes that's what it takes. I just don't have a lot of hope that we're going to find our way back to a world where it's going to be just wholesome, let's say American grit, go get 'em attitude. We're all here trying to do the best we can and improve each other's lives. I don't see a ripe landscape for that to occur. However, that's usually when things actually happen, is when they don't seem likely. So I'm super optimistic about the future of our entire marketplace. But I would say this is one of those, take a seat, sit on the sideline for this one. Don't get too heavily invested in this. Ironically, we're watching the crypto space change drastically, very fast in front of our eyes. Something that's been befuddling to most people. I won't talk about that in detail here, but I will say that landscape is one that I'm watching very, very closely because I think some of the evolutions that are occurring there are going to be quite positive. I am also seeing some that are very negative, but I think that as we look forward at the future landscape of our investment marketplace, I want to see small caps get their turn. I've been calling for this for quite a while now, but they need the right environment to succeed. And if those small companies start to succeed, even smaller companies are going to say, you know what, I'm not going to go this private equity where I'm basically enslaved by the private equity funders or whatever it is. I'm going to go public market and I'm going to grind. I'm going to do it the hard way. And if that happens, we've got another great opportunity set ahead of us. But in the meantime, there's a reason that we sit so heavily invested in our international markets and that we are a go anywhere type of investor. We are not, when we're looking at our wealth long term, we have to consider all of these different factors and how they play into constructing portfolios that work with us through our lives. And that is a big piece of this. It's how we invest. That's investing. So I hope this has been helpful. If you have any questions, concerns, thoughts, if you want to dispute anything that I've said here or kind of talk through it, let me know. I'd love to have a conversation about it. I think this is all interesting. And if you want to learn more, please do reach out to us. If you're not a client of Carriage House Planning and you're interested in becoming one, please visit our website, www.carriagehouseplanning.com. You'll see a link in the top corner to schedule an introductory meeting with me. I would love to have the opportunity to get to know you a little better, learn a little bit more about what you're trying to achieve, and see if we would be a great partner in helping you do so. And for those of you who are clients of Carriage House Planning, as always, thank you so much for everything, for the trust and faith that you put in us. And I assure you that what I am doing, what we're doing together, is for your best interest first, but it is to help navigate the chaos and the crazy that is our world. And it's always been crazy and chaotic. It just seems like it because we're living through it right now. But we will continue to navigate all of these new things as they come. But in the meantime, happy early fall, and I will look forward to talking to you soon. All right.